Okay, so if you're just joining us, I mean, could we make it any clearer? It's perfect, right? The Fed cut by a quarter point in case you can't read the block writing.
Right, and in case you can't read what's over my left shoulder, the market is now up 66 points, pretty healthy on the upside. The Federal Reserve Board, of course, didn't want to panic either one way or the other. At first, it was about flat, but now they're deciding they like the news. That could change by the end of the day.
So is today's Fed move a good move for America?
Joining us now, our Fox panel, Mike Norman, founder of Economic Contrarian, who is dying to get into the Steve Forbes debate there. Charles Massimo, president of CJM Fiscal Management. Nicole Ridgway, senior writer of SmartMoney.com. Peter Schiff, CEO of Euro-Pacific Capital. Before we get into Peter and Norman, who are going to dominate this conversation, I want to go to you. What do you think of the move?
Well, again, we're in the camp of you're a passive manager. You ignore this short-term information. But having said that, I think you got to be pretty encouraged. You have an economy where GDP is rising and interest rates are falling, which historically is very good for an economy. But more than that, the markets today and the economy today is controlled more by human psychology than anything else. And the psychology of the market right now is pretty positive. When you have short-term rates coming down, people who own mortgages feel a little bit better. They have a little bit more room to expand on their credit cards. So all that, I think, equals to at least a short-term positive move for the markets.
And my GDP came out looking pretty healthy today, but the dollar is not healthy. It's got an IV drip stuck in it right now.
Look, Liz, we added $53 billion in the third quarter in exports that contributed almost 2% to GDP, almost as much as personal consumption, all right? The weaker dollar is definitely adding as a stimulus to the economy. We had $100 billion in economic output in the third quarter when we had all these problems with housing and everything else.
My dollar doesn't buy what it used to, Mike.
Oh, yes, it does.
No,
oh, absolutely it does.
Maybe
if you take a trip to Paris or London, it's not going to buy what you used to.
Okay.
But you know, within the United States, the money that people earn right now, wait, Liz, this is very important. Real earnings now are the highest in 27 years.
Okay, hold on. Peter Schiff, take it, and let's get off the dollar here and talk overall about what it means for the person who's out there watching.
Well, the person who's out there watching has dollars. I mean, unless you're one of my clients, you know, Euro Pacific Capital clients don't have dollars. I've been helping my clients get rid of their dollars for years. We own euros. We own Canadian dollars. We own Australian dollars. We own foreign stocks. We own oil. We own gold. So if you own those things, then this is not a disaster. But if you're the typical American who has dollar income, who has dollar-based investments, your wealth is evaporating.
It is
right
not
beneath
evaporating.
Okay, hold on. We haven't heard from Jim Petticockis. Jim, if you're looking at the big board, be quiet for a second, Mike Norman. If
you're the one that gives out misinformation,
you're looking at some very positive numbers. It's up 72 now. So somebody's buying with dollars.
Well, that's right. And I think one reason, the market's up is that I think investors, even though the market tailed off a bit at the beginning, I think they're hoping that the Fed knows something that they don't, that the Fed knows that the housing, as bad as it is, it's somewhat containable. Now I question that. I can help but wonder if the Fed shouldn't have gone faster and further here, maybe gone 50 to get fully ahead of this housing problem. But you're right. 3.9% GDP with all these problems, I mean, that's an incredible number.
It's not real.
Nicole, are you with us here? Nicole Ridgway?
It's not a real number. Measure our GDP in Canadian dollars.
Charles,
get real inflation rate.
Okay, listen, hindsight's 20/20, but as we look back on all of this in a couple of years, will the Fed look like a hero or a villain at this time?
Only time is going to tell. Peter somewhat alluded to it in the sense that if you're the right investor, if you're the investor that does it the right way and builds this broadly diversified portfolio, whether it's a combination, you can't just own European stocks because that eventually is going to come back to hurt you as well. But if you have a broadly diversified portfolio, what the Fed did today will mean very little in the next 2 to 3 to 5 years. So again, to make a decision today based on that is ridiculous.
Peter keeps repeating this thing, which is absolutely wrong, saying that those numbers are inflated. The numbers that are reported on GDP are adjusted for inflation. I told you that last time.
They're adjusted for the government's version of inflation.
So, okay,
Mike,
this is a classic. Somebody who doesn't know what they're talking about always reverts to, oh, so you're going to believe those numbers?
I don't know what I'm talking about, Mike.
Right? That's
for
what you
years,
want to do, is
hold
ignore
on,
the facts.
Mike.
Those are adjusted for inflation.
Quiet, Mike. Go ahead, Peter.
For years, I've watched you on television tell people that oil was going to go down, that gold was going to go down, that the dollar was going to go up. You've been dead wrong on every economic prediction you've ever made. Yet you're criticizing me.
The United States was going to go down the drain when we've added trillions and trillions of dollars in economic output.
Peter, wait. Camera over to us. Here's what you really need.
This is where the director has to follow the anchors.